Welcome to the Silver Report Uncut. Now we're seeing a very concerning trend going on. We are now seeing insiders, corporate insiders, are beginning to sell their own shares. And of course, who better understands the intricacies of the market and their companies than corporate insiders? And typically, they tend to aggressively offload shares at times when they see the price of their equity holdings as high. Now, according to research done by Smart Insider, they show that the market is currently the most overbought that it's been since the dot-com bubble. Also, quote, executives across the U.S. are shedding stock in their own companies at the fastest pace in 2 decades, amid concerns that the long bull market in equities is reaching its final stages, unquote. We see that corporate insiders so far for 2019, that would include CEOs, CFOs, board members, or other early stage investors, they sold a combined $19 billion of stock in their companies through mid-September annualized. They're on course to reach $26 billion for the year. This would also mark the most active year of corporate insiders selling their own shares since the year 2000. That was at a time when executives sold $37 billion of stock because we saw those extremely high asset valuations during the dot-com bubble. But get this, 2019 is on track to set a post-financial crisis high. Now, there was $25 billion worth of stock that was sold in 2017. That was the previous high since 2008. Now, we see companies like WeWork, Uber, Lyft, all with insiders selling shares. Also, the Walton family, they have sold a combined $2.2 billion worth of shares in their Walmart fiefdom. Also, executives at Estee Lauder, they've also been heavy sellers of shares. You have Lululemon Athletica. Among those three, they happen to be the most active sellers according to Smart Insider. So here's the thing. The reason that it's significant that insiders are selling their stocks is that traditionally, this is a good marker for the confidence of these executives in their own company's prospects. Now, if you remember, we had that Duke CFO survey, and what it revealed was that 2/3 of American corporate CFOs, they believe that a recession could happen before the end of 2020. So we already know their confidence is beginning to slide. They know there's not much hope for profits in their company. It's just there's some people out there who don't know, so they're trying to keep that quiet. Whenever you see jumps in selling, that means people in top positions in boardrooms around the country, they're taking advantage of these high valuations. And for those out there trying to say, well, this just always happens, it's nothing to pay attention to, the truth is, last year, we saw corporate insiders, they paused selling their stocks. Even among the worst December for U.S. stocks since 1931, we had a 20% drop in the stock market. We also ended 2018 down 6%, but at that point, corporate insiders, they were actually still buying stocks. Since then, we've seen the S&P 500 rise by over 20%. We've also seen central banks around the world have begun cutting interest rates, expanding liquidity operations. So if these corporate insiders are selling their stocks, question comes up, who's buying? We look at a Bank of America note to investors, and they brought up the fact that buybacks, they are running strong. Very strong. In fact, they said, quote, despite what is usually a seasonally weak time for buybacks, corporate buybacks remained strong last week, driven by tech for the 4th week in a row. Cumulative buybacks year to date are already up 20% year over year compared to 2018. Keep in mind, 2018 was already a record year for stock buybacks, meaning 2019 once again looks like it's set to break another record. Now, the rolling 4-week average of buybacks is at 122% year over year. This is the highest of any point throughout this year. Throughout this record year. Now, we see that this overnight funding problem, it's still a problem. Now, the New York Fed announced that their first $30 billion term repo operation was more than 200% oversubscribed. And we also see the results of the daily overnight repo operation were also published, and it confirmed that this liquidity problem is still getting worse. We saw the $75 billion cap on the operation, of course, was oversubscribed again at $80.2 billion in submissions that were tendered. Now, the total Treasury notional submitted for the repo was $58.8 billion. That's an increase of $9 billion from yesterday. And the amount of mortgage-backed securities rose to $20.85 billion. That was $15.45 billion yesterday, and only 15.89 billion was accepted. So the hopeful expectation was that this liquidity shortfall was going to dissipate as soon as the tax payments and bill settlements were absorbed. But now we see this funding shortage in the American banking system is getting much worse. In fact, when you add up the overnight and the term repo operations, there was a total of $142 billion in funding that was needed yesterday. That's the highest yet. To make matters worse, they now expect even more submissions into the next 2-week term repos. So we've been seeing a lot of need out there. A lot of demand for funding. And here's the thing about these overnight money markets. A lot of times banks attempt to hold off until the very last minute. So not only are these 2-week term repos probably not revealing of the true liquidity need, but wait until the second and third one come around. Most of the times, banks, they get a little nervous when relaying the information that they're short on liquidity. People tend to get worried, and it could cause some panics or possibly bank runs. Certainly, they would be impacted at share price. And you see, they act like 2007 literally caught everyone off guard. These banks, they knew. They knew their books were rotten. It's just, in the same manner as now, they attempt to hide all negative information about their current economic state. And that's why all of a sudden, you have those Lehman-like moments where everyone's surprised, everyone's shocked, and you see the markets begin to sell off for those big, hardy losses we see. So whenever the Federal Reserve begins handling these kind of operations, the bulk of the funding needs is yet to be realized in the market. That means we'll be seeing quantitative easing a lot sooner than these analysts anticipated. This could push the total liquidity shortfall into the high $165 billion range before the end of this week. So the New York Fed's first term repo operation, it was a 14-day term. So a little details about their term repo. The Fed accepted $22.7 billion of treasuries at a stop-out rate of 1.9% with a weighted average rate of 1.961%, both above the IOER. They also confirmed there is an ocean of demand with only a cup of supply. And here's the thing, the closer we get to the end of the quarter, the tighter liquidity will become. Now we see that repo opened up at 2.1% to 2%, and the term repo rates continue to be in the mid 2% range. It's really beginning to feel like this is the type of atmosphere where we could see some very stunning headlines coming up in the coming months. Similar to how that travel agency just ran out of money the other day because they could not secure their funding. With the increase of these highly leveraged companies, sooner or later, the odds increase that one of them is not going to be able to make a payment. So here's the thing. We see that confidence expectations, they've reached their lowest level in 2019, and in fact, in August, Americans were the most confident about the current situation since 2000. And of course, headline confidence was expected to fall in September, but it did, much worse than they anticipated. In fact, headline consumer confidence, it fell to 125.1. It was 133 last month. Confidence about consumers' present situation, it fell to 169. It was 176 last month. Also, consumer confidence expectations fell to 95.8. That was 106.4 last month. This is the largest drop in consumer expectations since December 2018, back when stocks were plummeting 20%. And here's the thing, all age groups, they saw confidence slide. But it also reveals that higher income Americans, their confidence dropped notably, while it was a little less for lower incomes. We also see that plans for buying homes, cars, large appliances, they have weakened dramatically. And as soon as this data was released and markets began to take notice to this drop in confidence, we also seen Treasury yields, they plunged. In fact, they were down 8 to 10 BPS across the curve. This was the largest yield drop in a month. Also, the 30-year yield has been down 6 out of the last 7 days, heading back towards 2%, as well as it pushed the 3-month and the 10-year deeper into inversion territory. I know one thing for certain, none of this falls into the definition of getting better. Alright, thank you guys for stopping by and joining us here at the Silver Report Uncut. If you like the content, be sure to subscribe, like the videos, share the videos, get the word out. I thank you so much for stopping by. as always, stay safe.